Good morning and welcome to the Saxo Bank Morning Call. It is Monday, April 8th, 2019, and a new week threatens. Last week, just to wrap it up with the U.S. jobs report, I think really disappointing. There was nothing disappointing on the non-farms payroll change, which was perhaps a focus after that really disappointing February print. But if you look at a couple of things, I think that, of course, the average hourly earnings only rising by that 0.1% month on month, and the participation rate dropping 0.2%. Real disappointing because it really appeared we may be having more participation, more people coming into the workforce, and that big drop puts that whole development into question as well. So, and then looking at the markets, we talked Friday again about this 1998 scenario, the melt-up scenario. I really think the key market to watch here across all markets is the U.S. Treasury market. I've got a chart here of the U.S. 10-year future. It's yield-wise, we're talking about the 2.5% to 2.6% range. You see the previous high there in the contract. And what we see, I think the message we're getting is that this market bounced. To me, not a very strong risk-positive move here from markets. And I think you need to see the ability for long rates to come up, even if the Fed and the central bank is going to remain accommodative. Really in a risk-on mood, I think you would see longer treasuries managing to see their yields rising, as well as we're seeing, of course, in equity markets very strong. And we're saying we're only at 2% now, Peter, from or so
exactly
from the all-time highs in the S&P.
Yeah, we are only 2% away from the all-time highs, and there's been a lot of engines carrying the equities higher, all the way from Chinese stimulus, the Fed's pivot on monetary policy, etc. And things seem to be stabilizing a little bit, but we're now moving into the earnings season. It's going to be quite interesting to see whether we can have another engine carrying equities higher. But I will say, though, and that's the whole point about the earnings, is that we've come very far on equities. We're discounting a very rosy scenario. So if we don't get a strong rebound, and then I think we actually could get a setback in equities. But if we look at the S&P 500 chart I brought with us today, you can see that 2% to the all-time highs back from the 21st of September. That's the spike there, and we had a slight, as you said, disappointing Friday's numbers here, but I think the momentum is still intact. But the earnings season is going to be key. If you take the next slide, John, here you can see the blue line, which is the S&P 500. The 12-month forward earnings per share has not regained its highs back from Q4 of last year. So we're almost back to the highs in share prices, but not in terms of forward earnings. So that means that the positive momentum in equities has been carried by a valuation multiple expansion and not underlying strength. So that means that, and I said that on Friday in my earnings preview, if we don't get strong earnings, I think actually we could be in for a pretty nice setback, maybe up 5 to 7% if we don't get strong earnings and confidence in the outlooks.
Okay, so if we look at also along in the currency space, I think the currency pair that to me really encapsulates everything. Hopes about the Asian rebound. We saw Aussie heavily bid last week, and that's I think one of the big developments last week. Very few developments in foreign exchange in general. But look at the chart here. You see Aussie yen. I think it'll be very much in line with our equities going higher, and especially our longer-term bond yields in the U.S. Going higher or not, and that's going to define the market's attitude on risk on, risk off. So far, the range holding there, and I would suspect it continues to hold if the long end of the curve stays tamed. One thing that's not really particularly staying tamed is oil prices. We've got this Libya situation, and we've got the $70 sort of level.
Absolutely.
And Brent violated here.
Yeah, we've been talking about oil prices for a while now and continue to grind higher, but we have another move higher this morning, as you can see in the chart here. As John mentioned, we are now above the 200-day moving average. We're above $70 in Brent crude. It's a focus on Libya once again. Not only do we have Iran and Venezuela to worry about in terms of sanctions and crisis, Libya now is we've had unrest in Libya now for almost the past decade. But we have some militias, Haftar, which is moving towards Libya, and that's really starting to raise the game there. The LNA, as it's called, is backed by Russia, so there's obviously some geopolitical aspects there as well. But you can see the roller coaster right over there since 2010. That's Libya's oil production. We've been up and down, and we just recently reclaimed the 1 million barrel. But if we start to see a sharp drop if it really escalates, a sharp drop in production from Libya, then we have to think about the 1.7 million barrels that we lost from Venezuela and Iran over the last year. So again,
supply worries.
Yes, it's a lonely place to be a bear right now in the oil market. So we're above 70. As long as these uncertainties persist, we can move up towards 75.
And we talked about treasuries, direction and risk appetite, but also in treasuries, and I think that of course impinges a lot on the gold market. But there's another story here, an actual Chinese buying of an actual fundamental story behind
Yeah, the physical market continues to remain strong. We've seen Russia being a continuous buyer for quite a while now, but China started to return to the market last December, and they've been steadily buying ever since. I think it's just in the tune of 10 tons a month. And you can see on the chart again how we broke higher, or we saw a big pickup in, actually in 15 was because they haven't reported gold buying for many years, so suddenly they started to reporting it. Then nothing happened for a few years, but now they've been buying for the past 4 months. But obviously hedge funds and other speculators, they're caring more about the short-term development, and the price we currently seeing with the move back below 1300 last week really triggered quite a big reduction in the net long. So the net long is very limited right now. I've put out the report on home.saxo in an hour's time or so, but again, the market is really don't know what leg to stand on right now.
Right, and then on currencies, in terms of positioning, you put out your weekly positioning report, and you noted another big increase in that euro-dollar short position.
Yeah, that's now at I believe it's 27 months high. So the really big focus on shorting the euro, even though we haven't seen a break.
Yeah, exactly, and that's I've got a chart here. It's not really a big technical chart in terms of the focus, but the 112 level. Clearly a big one. The red line there is the rate differential, which of course threatens to head higher, because if the Fed is seen as cutting rates and the ECB basically can't cut rates anymore, that spread could head higher. But you can also see that this has not been a very good indicator for euro-dollar direction, so that logic is a bit difficult. And I would argue there's also maybe more interested in U.S. assets than there is in European assets, which could be a driver as well. In any case, watch that 112 level. It's a really important one that's been in place for several months now. As foreign exchange traders, I think maybe getting complacent. The volatility is very low. I suspect there's a lot of volatility shorting out there, so be wary of short-term moves. Before I get to the macro calendar, I wanted to, Peter, you had a slide on some of the earnings releases. We're getting into full swing here pretty soon on earnings.
Yeah, we're getting into the Q1 earnings season, and we have around 40 companies reporting out of those 2,000 that we tracked during the earnings season. And in terms of the U.S. season, it starts really on Friday with JP Morgan and Wells Fargo. If you look at the table, you can sort of see all the names. I did write that preview, as I talked about, on home.saxo under my profile. The week after, we really swing into gear with around 200, 300 companies reporting. So there's not much to say. I think it will really be the U.S. financials on Friday that will set the stage for where we're going, and it will be quite interesting to see what their anticipation and also what their reaction is to the change from the Fed, because the yield curve is flattening or even inverting, which is bad for returns of banks. We have very, very low M&A activity. I think it has been the lowest for more than 5 or 6 years. Trading is not going well, so I'm really curious to see where these U.S. banks are, because they were really pulling the equity market higher together with technology stocks over the past years. So.
All right, and then on the macro calendar, we have very little today. Slow start to the week. We have Canadian housing starts up today, factory orders out of the U.S. But then it's really Wednesday. We swing into gear with the ECB meeting, although not much expected there. The March CPI from the U.S., the minutes of the FOMC could be interesting. And then this Brexit summit. Surely we get some kind of development this week, or do we just get another delay? And what is the nature of that delay? Complete unknowns, and you see that reflected in the price charts with sterling completely locked in a range. I don't think anybody's any the wiser on where this is headed. May trying to put together these talks with the opposition, but they can't agree on a path forward, and the whole idea of a very soft Brexit and joining the customs union is very unpopular. It looks to me like we end up longer term potentially with a second referendum on no deal versus whatever the other option could be. So look out for that. I suspect we may still not be any the wiser next week either on Brexit. That's it for today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.